Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is how the Basel Endgame proposal may affect mortgage markets. As you've heard by now, my name is Matt Bisanz, and I'm a bank regulatory partner in Mayor Brown's financial services practice. We've been doing a series of these programs on the Basel Endgame proposal because of its significant impact on the U.S. markets, not only for banks, but for their customers and counterparties. Joining me today to talk about mortgages are two of our experts on the topic. We are joined by Haukur Gudmundsson. He's a partner in the firm's finance practice and focuses on structured finance and other transactions involving residential mortgage loans and other residential real estate assets. Also joining us today is Chris Smith. He is next door to me, actually, in the DC office, and he focuses on mortgage servicing rights and whole loan transactions. And so he's really good at figuring out how to carve up those rights and assets off of the loans and what they mean in the commercial market, which will be affected by this proposal. Thank you both for joining me today on this program. To dive into things, the Basel Endgame proposal is not specifically targeted at the mortgage markets. That it is over 1,100 pages, and it targets really every product and service that a bank offers, particularly any lending or credit exposure a bank has. As we've covered on prior programs, it affects things like a bank's investments in different types of securities. It covers wealth management products, credit card products, other types of unsecured lending. But for our purposes today, we're going to talk about how it affects the mortgage markets. When we think of mortgages, there are commercial mortgages, which we covered on the program from a few weeks ago. And then for many of us closer to home, pun intended, there are residential mortgages. And from a bank's perspective, residential mortgages present a number of capital considerations, particularly given the long duration of residential mortgages in the U.S. market, that mortgages, again, can go 30, 40 years for a resi mortgage. And so a bank that is holding that loan for the long term is exposed to the credit risks associated with that mortgage for the entire life of the loan. That makes it very important for the bank to understand the capital requirements it will need to hold against the mortgages during that life of the loan, because if those requirements are on the high end or if they increase over time, then that can make the loan unprofitable for the bank to engage in. Moreover, as Chris and Haukur will talk about, there are other elements to mortgages that affect their value to banks, their cost to banks, and their attractiveness in the market. That mortgages can be split into the right to receive the payments from the loan and also the right to receive the servicing fees on the loans. That's what Chris is an expert on. And so there are capital consequences associated with mortgage servicing items. And while those have historically been punitive, as Chris will say, things could be getting worse for banks. Also, mortgages can be repackaged into structured finance products. That's what Haukur's expertise is here. And when they become a mortgage-backed security or other instrument, particularly if they are subject to protection from a GSE like Fannie Mae or Freddie Mac, then they become tradable in the market. And so they can be used as collateral and other items beyond just an investment in the housing sector. And Haukur will talk about some of the considerations there, as will Chris. But overall, really, the point we're here to talk about today is that while the proposal on Basel Endgame has attributes, while it is framed by the regulators as providing certain benefits to mortgages, mainly in lower risk weights for conforming loans, first lien mortgages, that really isn't the whole story. That we've already talked on prior programs about how those lower risk weights are not as advantageous as the regulators say, but even conceding that in some cases they may be lower than the current risk weights, there are other features in the proposal that will increase the costs of banks facilitating the mortgage market. Things ranging from limits on MSAs, on the amount of capital banks have to hold against unused warehouse lines, and also on the attractiveness that banks will have for holding or taking mortgage-backed securities as collateral. But I've been talking for a while now, and so let's get things started with a little bit of depth in the mortgage servicing space. Chris?
Thank you, Matt. As Matt just mentioned, there are the proposal first addresses some threshold issues. So the proposal would require all banks with total assets in excess of $100 billion to deduct mortgage servicing assets, or MSAs, what we typically think of as mortgage servicing rights, from capital if the MSAs exceed 10% of bank capital or 15% of the combined deduction limit. Today, this threshold applies only to the 8 U.S. global systemically important banks. And smaller banks, in contrast, are currently subject to a much more generous 25% capital threshold. Under the proposal, about 30 new banks would be subject to that 10% threshold. And there are concerns that this is going to disincentivize smaller banks from holding large mortgage servicing asset portfolios, so as to avoid exceeding the threshold, which in turn is just going to drive more mortgage servicing to the non-bank sector, which already the GSEs are targeting for holding too much servicing rights. Haukur, can you discuss how the proposal addresses risk weighting?
Yeah, thank you, Chris. I was going to talk a little bit about the risk weights for investments in Resi mortgage loans. And like Matt said at the outset, the Endgame proposal is pretty vast and covers a lot of different assets, and is not focused on residential mortgages by any means. And so I think it can be kind of difficult to speculate on what impact it's going to have on the mortgage market, generally speaking. There's a lot of nuance in the proposals, and the market, has a lot of other factors that kind of determine how things go in the mortgage market. But if we look at the categories of mortgage loans in the existing rules, there are effectively 6 categories of residential mortgage loans that are assigned a risk weight that range from 20 to 150 for 150% for past due loans. 4 out of those 6 categories effectively remain the same in the Endgame proposal. The fifth category is divided into 14 new categories that, as far as categorization goes, match up with the international standards. And then there is a fallback or a catch-all category for other residential that has some important changes that we'll talk about as well. The rub of it is, like I said, 4 of the 6 remain the same. The qualifying first lien residential category that under the current system carries a 50% risk weight is now split into 14 new categories tracking the international standards, with risk weights ranging from 40% to 125%. And when we compare the risk weight that's applied under the this proposal to the international standards, I think that the correlation is pretty straightforward. The Endgame proposal has each category carrying a 20% higher risk weight than the international standard. So for the lowest category, consisting of not cash flow dependent loans with LTVs of equal to or less than 50%, the Endgame risk weight is 40% versus 20% in the pursuant to the international standards. On the high end, for cash flow dependent loans with LTVs of greater than 100%, it's 125% compared to 105%. And the regulators haven't really provided much of an explanation for that difference and why it's appropriate, whether it's appropriate on some policy basis or whether there's some kind of empirical evidence underlying that 20% bonus, if you will, that the Endgame proposal has compared to the international standards. I guess the regulators have kind of suggested that it might be in part to avoid giving internet or regional banks, the larger banks, and a competitive advantage over smaller banks. But there's not really much of an explanation beyond that. And it's kind of curious, I suppose, to think about it, because at one level it seems to, if we think about the 20% difference, it seems to be relatively more. It seems to favor more the riskier assets, right? Difference between 40 and 20 on the kind of 50% or 50% LTV is a 50% difference. So on the safer assets, there's a relatively speaking larger gap between the international standards and the Endgame proposal compared to the presumably riskier assets on the higher end of the LTV spectrum. But if we want to speculate about what impact that's going to have on the housing market, I mean, I think all other things being equal and maybe recognizing that all things are never equal, you would expect that the banks that are subject to the Endgame proposal would be looking at less likely to invest in higher LTV mortgage loans and more likely to invest in lower LTV mortgage loans, where the weighting is actually going to go down compared to the current 50% threshold. The other item to kind of note in the risk weighting is the catch-all or the fallback bucket of all other, or what now is going to be called other residential. And what's in that bucket is, I suppose, other residential, what's called in the proposed regulatory residential real estate exposure, which consists of first lien residential mortgage exposures that are, secured by property that's owner occupied or rented, made in accordance with prudent underwriting standards, is underwritten pursuant to the ability to repay regime, and meets certain criteria with respect to the valuation of the underlying property. And then if the mortgage in question does not fit that definition, it'll fall into that bucket of other residential. And if it does, then it either will be subject to 100% risk weight, which is consistent with the current all other bucket of residential mortgage loan, or it'll fall into the new bucket of 150% risk weight, which seems to the determining factor of which of these risk weights apply is whether the exposure is dependent on cash flows generated by the real estate or not. And if it's dependent on the cash flow, 100% risk weight applies, and if not, 150% risk weight applies. And all that being said, I think the big kind of conclusion here is, and in this current marking, probably the most relevant feature of this proposal is its application to second lien or junior lien residential mortgage loan to individual owner occupied residences that are not cash flow dependent, where the applicable risk weight for the subject bank is going to jump from 100% to 150%. And I think that's going to be particularly relevant in a market as we're in today, where interest or increasing interest rate environment kind of spurs the demand for second liens as as refinancing kind of becomes prohibitively expensive compared to recent interest rates on residential mortgage loans. The last thing I wanted to talk about that may be relevant around the margins is on warehouse facilities. The proposal assigns a 10% credit conversion factor to undrawn commitments that are quote unquote unconditionally cancelable, which is an increase from the current 0% factor. The implication of that in the residential real estate may be not that significant. I'm noting it here because I think it applies in certain circumstances, maybe more commonly in the commercial real estate. But in the resi space, I think most mortgage warehouse facilities are either committed, meaning that to the extent that the borrower satisfies certain eligibility criteria, the lender is committed to fund up to the committed amount, or they are categorically and clearly uncommitted and clearly state so. The scenario where this would apply, where the facility is committed, but the lender has the ability to cancel, is not that relevant. But to the extent that those facilities exist, I think banks that are subject to those rules are going to be looking at those pretty carefully, and presumably the price of them will increase. And that, I think, is it for me. And so I'm going to turn it back to Chris to talk a little bit about securities, repos, and market risk boundaries.
Thank you, Haukur. The other thing that the proposal would do is require banks to haircut the value of mortgage-backed securities pledged as collateral for securities borrowing and repo transactions by at least 7%. This is true even if the MBS is backed by Fannie Mae or Freddie Mac. The proposal treats Fannie Mae and Freddie Mac mortgage-backed securities the same as private mortgage-backed securities, which ignores the fact that in comparison to private MBSs, Fannie Mae and Freddie Mac exposures have a lower risk weight due to their status as GSEs. The concern here is that that's going to discourage borrowers from pledging GSE mortgage-backed securities, resulting in transactions ultimately becoming more expensive. We've actually heard from some of our contacts in the market that they will cease transacting in this space under the proposal. So there's a little bit of support for that concern. Finally, note that currently most mortgage exposures held by banks are treated under credit risk provisions, which focus on the risk of default using well-defined and pretty well understood criteria. Exposures that primarily are valued based on the risk of pricing changes are treated under much more complicated and punitive market risk provisions. This proposal will actually shift the boundary between credit and market risk subjecting more exposures to the market risk provisions. As a result, under the proposal, it's more likely that both commercial mortgage-backed securities and residential mortgage-backed securities are evaluated under the more punitive market risk rules. And again, our concern is this may have the effect of discouraging banks from facilitating trades of mortgage-backed securities. Matt, can you close us out?
Sure, thanks, Chris. I think one of the themes that has come through in a number of areas of the proposal is that the regulators want all banks to effectively look the same. And that is why there are these rigid categories, these general rules like treating all MBS the same, even if they have Fannie or Freddie coverage. That's why there is the punitive risk weight if a resi loan is not perfectly fitting within the box. And for on one hand, the regulators say, well, we've determined these are our lower risk features for the banking industry, but the part they seem to be neglecting is, I guess, two parts they seem to be neglecting is, first, they are creating some systemic risk. If things like mortgage warehouses were to become less available, that would seem to have a hugely negative effect on the non-bank mortgage origination sector. Or if people were to stop pledging mortgage-backed securities for repos and other securities lending transactions, again, that would seem to have a negative impact on the liquidity of that sector. But more importantly, there are businesses behind each of these categories that we've been talking about today. That, like I said, Chris has made his entire career on transferring mortgage servicing assets. And so for the top 30 or so banks to all of a sudden say, we don't want to buy any more mortgage servicing assets because we need to make sure we stay below that 10% cap, that will restrict the market, that will restrict deal flow, that will make things more expensive, that will make, as he also noted, things go into the non-bank sector. And that generally, that kind of friction would be negative for the economy. Similarly, like Haukur said, that if we get rid of, or if second lien mortgages become less available from these 30 banks or 40 banks that are affected because they now have a punitive risk weight, well, that will encourage borrowers to seek out potentially less advantageous or less appropriate products, say loans from non-bank mortgage lenders, unsecured loans, loans secured by other assets that have a higher default rate. And so the overall theme here seems to be that by reducing the diversity of business models in the financial system, the proposal could negatively impact the mortgage markets. But I think that's something we will be seeing over time. Chris, Haukur, I really want to thank you guys for coming on this program. It has been great to hear your thoughts on these important issues. And as always, to our audience, thank you for tuning in. If you weren't listening, we wouldn't have a reason to do these. If you have any questions, please feel free to reach out to Chris or Haukur directly, or to send us an email at gfm@mayorbrown.com. Thank you and have a great day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.